What happens if Schwab goes bust, or Fidelity or Robinhood or any other brokerage firm? One of the most frequent questions we get asked is which brokerage firm to use. Let's get down to brass tacks. Usability, nice to have. Being able to get your money out, must have. Today we'll take a look at what happens if your broker goes bust and what you need to do to keep your investments safe. Why should I be talking to you about this? Well, I have a dual master's with a finance focus, and I spent over a decade at one of the leading firms on Wall Street. That's the bad news. The good news is that I have several decades investing experience, and I've learned a lot just from making mistakes. Most important lessons weren't taught in schools or on-the-job training. There is no free lunch. You get what you pay for. Creating wealth is a long, slow, boring process. There's no substitute for hard work. The harder you work, the luckier you get. And there's charlatans everywhere, and they're masters of disguise. You are responsible for your investment decisions. I'm simply going to provide some information that helps you. Now, let's talk a little bit about the past of brokerage firms. So when retail investing platforms first came online, the cost of a trade used to be a thing. Brokerage firms would charge $7 to $9 a trade, and then some of them started undercutting the others. So they'd say, well, we'll charge you $4.99 per trade for 6 months, that sort of thing. That's when Robinhood changed the game, but as always, there is no free lunch. We'll talk about that. Now today, several things should be top of mind for retail investors shopping for a broker. So must-haves. First of all, free trades for major U.S. markets. That's just a given. No recent arrival fintech platforms. Whatever functionality they're offering can easily be duplicated by large firms. It's just not worth the risk. No past track record of pushing clients towards garbage. So for example, Robinhood, the largest ever FINRA penalty for system-wide outages and misleading their investors. Contrast that with Vanguard, who refuses to touch crypto. Appropriate regulatory protection of the type we're going to discuss today. A recognizable brand name with lots of assets under management and a high customer account. Now that can be a bit confusing. We'll talk about that. Avoid anything that isn't a well-known brand name, and that will ensure you steer clear of any sort of Ponzi type problem. So I came across this chart by Visual Capitalist. It's quite good. It shows a number of variables here for each broker, and they rank them all. And I pointed to the two that I've used most frequently, still use today. Schwab, I use them because they offer excellent compatibility for international travel, more so than the brokerage element, though that's pretty good too. They refund ATM fees, which I quite enjoy. Anywhere, it doesn't matter if you're buying cannabis or at a strip club, so I've heard they'll refund your fees. Interactive brokers, they handle Forex seamlessly, so I spend most of my time abroad, and that is very relevant for me. They also allow you to purchase foreign stocks using foreign currencies. Now, you see some of the other items here. Mobile trading, that's not something you should care about, as they say. The quickest way to reduce volatility in your portfolio is to stop looking at it. I also wanted to note transfer agents. So I've utilized them for a long time. Before there was free trading, you could use transfer agents. These are a trust company, bank, or institution assigned by a corporation for the purpose of maintaining an investor's financial records and tracking each investor's account balance. So they'll actually print you a certificate that shows the shares are in your name. So it's a way to facilitate direct share ownership. And I think I've used all these firms here, and I still use them to really minimize systemic risk. It's good to spread your assets around various institutions. But when we look at the largest brokerage firms by assets under management, I pulled this up here for the Motley Fool. Now, you see the numbers there on the right, their assets and their active accounts. Now, AUM numbers can be quite deceptive. Assets under custody is more appropriate, and we're going to take a look at that difference between the two in a second. What I wanted to point out here is visibility. This is very important. So if a firm with 50 million customer accounts goes pear-shaped, what sort of societal pressures do you think might be placed on government to make things whole? Foreign investors need to pay attention to these same things, although emerging markets may be an exception. I can think of perhaps in India when one of their largest brokerage firms ran into problems. So when we look at Charles Schwab, the topic of today's video, I came across this piece here, I think by the Wall Street Journal. It says, Charles Schwab just survived a year from hell. The trouble isn't over yet. And this prompted some of our paying subscribers to ask about this particular situation with Charles Schwab. We thought it was a good chance to address one of the most frequent questions we get, which is what brokerage firms ought you to use. Now, the problem with Schwab is said to relate to client cash sorting. So this is their average bank account deposit balance in millions of dollars over time, and they receive interest off of that. And the problem is that you can see that's declining. Now, your job isn't to actively assess the health of a company that holds your money. Rumsfeld's unknown unknowns will blindside even the most eagle-eyed analysts. Instead, just assume complete catastrophe. If Schwab goes bankrupt tomorrow, what's going to happen to your assets, right? So when we think about banks versus brokerages, I liked this piece here by Associated Bank. Now, assets held in a bank custodial account are held on behalf of the institution or individual and not counted on the bank's balance sheet. This is very important. You see here it says, these assets are not subject to claims from the bank's creditors should the bank fail. That's very important. Now, assets held by a broker are often commingled together and may be subject to distribution to the brokerage's creditors should the institution fail. So, immediately we want to understand how our assets are being held at Charles Schwab. So, they provide this document here, how client assets are protected at Schwab, and it says, in the unlikely event of insolvency of a broker-dealer, these segregated assets, so they, as I just described, keep their clients' assets segregated, are not available to general creditors and are protected against creditors' claims. That's great, so we should sleep well at night. Well, what if they're lying? Okay, let's talk about that. There's something called the SIPC. They protect against the loss of cash and securities held by a customer at a financially troubled SIPC member brokerage firm. That happens to be Schwab. Now, the limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. So you may want to keep that in mind when you're considering systemic risk. Spread your assets out. Now, most customers, they say, of failed brokerage firms are protected when assets are missing from customer accounts, all right? So as we said, if something really goes pear-shaped. And there's no requirement that a customer reside in or be a citizen of the United States, so foreign investors take note. So when we dig into that Schwab document more, they talk about, specifically point to SIPC protection, protects customers of SIPC member broker-dealers if a firm fails financially and assets are missing. Same language there. You see here, due to not record-keeping errors or misappropriation, in other words, fraud, customer assets are made whole by SIPC up to $500,000. The same language that we saw before. So consider a $500K limit on any account that's not a major name in the industry. And even if it is a major name in the industry, you might, for those that don't have that many assets, certainly could utilize this, though if you start to get into the $10 million in assets, might start to get a bit tough. But as I said before, when you stick with brand name firms, you can be sure that there's a high probability the government's going to make sure that everybody's kept whole just based on societal pressures. Now, there's also something called FDIC, and this refers to bank accounts. And you've probably heard this in the context of your own bank. And I came across this piece by Investopedia that raises some eyebrows. Are all bank accounts insured by the FDIC? Not all banking institutions are insured. Well, that's a problem. It says here credit union accounts are insured by the NCUA, not the FDIC, also up to $250,000 per depositor. So typically, when you have your money in checking and savings accounts at Schwab, then it applies, the FDIC rules apply. Whereas in your brokerage account, when you have cash and stocks, because you can keep a cash balance in either of those accounts, then the other rules apply. And as I said, this is simply based on what Schwab says. Now, if you're interested in knowing if the bank that you bank with is a FDIC insured bank or not, you can simply go to the FDIC website here. You see, find institutions by name and location and look up your bank. It's quite simple, right? And they even have this advanced screen where you can put in all your banks and your accounts, and then it'll produce a report that shows what coverage you have. Now, a question I've seen raised a fair amount, what about M1 Finance? So this is a firm I see lots of quote-unquote influencers out there pushing. And you see some of the questions being asked in Google about M1 Finance. Notice how they're all concerns. What company owns M1? Is M1 a Chinese company? Is it safe to invest in? Who are the owners? What banks work with them? How trustworthy are they? Et cetera, et cetera. Now, first of all, when you go to this firm's website, remember I talked about companies having your best interest in mind. This doesn't look so good. So very prominently displayed there on their interface is borrow. And you see here, borrow in seconds. That's not how margin accounts are supposed to work. You leverage your portfolio. You're not supposed to be able to do that. It says any M1 client who has $2,000 or more invested in an M1 individual brokerage account, etc., is eligible for an M1 margin loan. That's not how that's supposed to work. You try to get margin at Interactive Brokers, at least in all the accounts I've opened with them, they always want to know how much experience you have. Sure, you can lie your way through it, but at least they're making it somewhat difficult for you to get approved on margin. Here you can see they're pushing you to do it and suggesting all these things you could use your margin money for. This is not a good idea. Was it someone once said that the most sophisticated investors won't touch margin, and those investors who aren't sophisticated definitely shouldn't be using margin. That's so very true. So when you look at account protections, and I looked down these bullet points, and this just starts to become a little shifty. They say, all right, the cash balance in your cash account is eligible for FDIC insurance. Once it's swept to our partner banks and out of your brokerage account, okay. Until then, it's protected by SIPC. Sure, but we get down to this last bullet point. Customers are responsible for monitoring their total assets at each of the sweep program banks. How the hell am I supposed to know which banks my assets are? And they say, oh, a complete list of participating program banks can be found here. Yeah, I clicked that link and there was nothing there. So that's a little bit of a concern. Just some additional thoughts here. Foreign domicile bank accounts in foreign currencies offer added protection. So this is a way, really, if you work abroad, you can access foreign bank accounts and retirement plans, and I've done that on multiple continents, and it works out pretty well. Spread your wealth out, check your cash deposit limits as we did today, and stick with publicly traded firms. So they're going to have to disclose everything, and they're going to be audited by leading accounting firms. So as I said, going back to that big brand name, if you have 30 million other people that have concerns and they're all being raised, then the government is prone to listen to that. Now, for the foreign investors, I know that half of our paying subscribers and half our audience are foreign investors, but it becomes very complicated when you start looking at brokerage firms overseas. You have an equivalent here, the European Banking Authority. You see they have €100,000 deposit protection, things like that. So the same method of analysis that we've used today should be applied to evaluating brokerage firms in any jurisdiction, so large brand names. Now, when I was looking at M1 Finance, the founder had published a blog piece that was very informative, and he proposed this old book here. I think it's from 1940. It reminds me of reminiscences of a stock operator. It's Where Are the Customers' Yachts? And it refers to a story about a visitor to New York who admired the yachts of the bankers and brokers. And he naively asked where all the customers' yachts were. Of course, none of the customers could afford yachts, even though they dutifully followed the advice of their bankers and brokers. So there was some sage advice to be found in this book. Wall Street is not in the business of making you money. It's in the business of generating transactions. Going back to that point about firms having your best interest in mind. Thousands of erring humans of varying degrees of goodwill solemnly engaged in the business of predicting the unpredictable. That describes how the market works. Now, if you're not a skeptic, you're not an investor. That's the red flag approach we take here at Nanalyze. And they say the countless financial cliches amount to an attempt to sound smart while saying nothing in numerous ways. That's like the cautiously optimistic phrase, right? So we make sure we keep things real simple. It says the burnt customer certainly prefers to believe that he has been robbed rather than that he has been a fool on the advice of fools. We see this a lot with some of these meme stocks, this absolute crap MMAT types out there saying they've been robbed. No, you've been fleeced. Speculation is an effort, probably unsuccessfully, to turn a little money into a lot. That's what these people are leaning towards. Investment is an effort which should be successful to prevent a lot of money from becoming a little. It's exactly the risk management approach we take here at Nanalyze. So I put up another video here that you might be interested in. Please give that a watch. Make sure to subscribe to our channel for lots of other good content coming. Thanks so much for taking the time to watch this today.